Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about CIFR.
Now, CIFR Mining, Inc. has been arguably the most fascinating and, volatile equity in the digital infrastructure and energy space this past year.
It really has. What makes CIFR so compelling is that we're watching a corporate metamorphosis happen in, real time. This company is pivoting, and decisively so, from a pure-play Bitcoin miner, where its fortunes were just tethered to crypto prices, into a high-performance computing or HPC and AI data center landlord.
And the core evidence for that transformation is impossible to ignore. It's that 15-year, $5.5 billion lease agreement they secured with Amazon Web Services.
Which is a game changer, you have to admit.
Oh, absolutely. It's a game changer by any measure.
And yet, despite securing that headline-grabbing investment-grade contract, the stock's behavior has been, just utterly chaotic. If you look at late 2025, particularly the beginning of December, we saw this incredible push and pull. Sharp 10% drawdowns followed immediately by 9% rallies. And crucially, this volatility has largely decoupled the stock from Bitcoin's own price movements.
Right. And that decoupling points us directly to the central conflict. And the question we really have to address is the current market valuation and the frantic share price action of CIFR, primarily driven by the long-term bullish fundamentals of its AI pivot, its future, or is the stock structurally controlled and actively suppressed by the systematic supply-side pressures from the legacy majority shareholders' calculated exit?
I believe the answer lies squarely in that long-term value proposition. I contend that the fundamental AI/HPC pivot and the resulting visibility into billions of dollars in future revenue, that's what will ultimately dictate CIFR's trajectory. The structural noise we're seeing is simply the friction of a massive but temporary ownership transfer.
That's a compelling argument. But I think you're confusing the signal with the noise. While the fundamentals are certainly brilliant potential energy, I argue that the complex technical and structural dynamics, specifically the relentless selling from legacy insiders, are the dominant controlling force here. They're driving the short-term price suppression and volatility. Until that massive supply overhang is entirely absorbed, the fundamentals are basically trapped, held captive by financial engineering.
Well, let's focus on that potential energy because it is seismic. CIFR has essentially achieved the holy grail for a crypto miner. It's secured investment-grade, fixed revenue contracts with the biggest hyperscalers in the world. That $5.5 billion AWS deal provides a rock-solid foundation that fundamentally transforms the risk profile of the business from speculative mining to, predictable energy infrastructure.
Mm-hmm.
And this is why the multiple expansion thesis is so potent. The business is fundamentally shifting away from a volatile crypto miner multiple, which, typically floats between a low 4x to maybe 8x EBITDA when crypto is strong, toward a stable digital infrastructure and data center multiple, which often commands 20 to 30x EBITDA. And analysts are already validating this shift, reflecting this future value with price targets stretching up to $30.
Right.
Moreover, even while doing all this, the Bitcoin mining baseline remains robust. They boast one of the industry's most efficient fleets, measured at 17.3 joules per terahash. For listeners unfamiliar with that metric, think of it like a car's miles per gallon. 17.3 is excellent efficiency. It means they're using less power for more computational output. And this allows for a prudent hybrid treasury strategy, where they can sell a small portion of production, like the 42 Bitcoin they sold in August, to maintain liquidity without these constant dilutive equity raises.
That operational strength is undeniable. I'll grant you that, but it still exists within a flawed capital structure. I agree the AWS deal is transformative, but the stock is currently subjected to what I'd call a liquidity clash. On one side, you have high-profile institutional money firms like Jane Street, Citadel, entering aggressively, initiating large positions. But this inflow is being systematically and aggressively offset by a relentless, massive supply overhang from legacy insider capital, primarily BitFury and V3 Holding.
But what about cleaning the cap table? The mandatory redemption of warrants back in November?
I was getting to that. While the mandatory redemption of warrants in November 2025 via cashless exercise did eliminate a complex derivative liability, making the cap table cleaner for institutional analysis, it only really paved the way for the principal shareholders to execute a much more aggressive and sustained exit strategy. And that exit strategy is where the true structural friction lies. Consider the sheer scale of the supply overhang. V3 Holding Ltd. reduced its position by over 31.7 million shares in the third quarter of 2025 alone. That figure represents a 32.5% reduction in their overall holdings. I mean, that translates into hundreds of millions of dollars in selling pressure that the public market must absorb just to hold the line.
Okay, that's a significant number.
And it gets more technical, unfortunately. We have to talk about the variable prepaid forward, the VPF sale contract, entered by Bitfury Top Holdco covering up to 5.5 million shares for a $94.6 million upfront cash payout. This isn't just a simple share sale. It's a sophisticated financial engineering marvel designed to monetize their stake without crashing the price immediately.
So break that down.
Okay, think of the VPF like this. Bitfury essentially got a massive loan from a bank today and pledged the CIFR shares as collateral to pay it off later. But because the bank, the dealer, is now exposed to the risk of the stock price dropping before the contract matures, they must immediately short the stock to hedge their position. That action is purely mechanical, and it instantly creates structural price suppression right into the market, regardless of any good news.
That's an excellent explanation of VPF mechanics. And I acknowledge that structural short is real. But let's look at the result of that short. Institutional buyers are absorbing this supply precisely because they believe the stock is undervalued based on future earnings. This leads us neatly into the microstructure of the market, specifically the high off-exchange activity. I agree that the off-exchange short volume ratio frequently ranges between 35 and 55% of total volume. You cited a spike to almost 55% on December 4th, for instance. But this is not malicious. I argue this reflects efficient, smart money accumulation and rotation. When institutions like those buying the stake execute massive block trades, moving shares from Bitfury to new quantitative funds, that use dark pools to prevent massive price slippage that would ruin the trade. It's an essential, benign function of managing a large, complex shareholder rotation.
But I'm sorry, but I just don't buy that the high off-exchange activity is purely benign when we discuss price movement. While the use of dark pools is intended to prevent slippage, the primary function of that massive off-exchange short volume, even if you categorize it as hedging, is to facilitate the Bitfury exit at the most favorable terms for the seller. Market makers are heavily involved in managing this immense supply, absorbing it, and managing it off-exchange to prevent a panic on the public NASDAQ order book.
But it's still just a
The high shorting volume, whether you call it delta hedging or facilitation, is functionally a mechanical supply absorber. It creates a ceiling. Every time fundamental demand tries to push the price up, this managed supply sitting off exchange and managed by the dealers can be released in a controlled way to quench that upside momentum. The AI thesis is running a race with a heavy anchor attached, and that anchor is supply absorption.
That heavy anchor, the high short interest, is precisely what excites retail investors who see the potential for a short squeeze. And it is high, standing at roughly 20.5% of the floats in mid-November 2025. But as we've established, a substantial portion of that is not outright bearish speculation against the AI pivot. It's the structural hedging related to the VPF and other derivative instruments used to liquidate the insider stake. The crucial point here is that this structural short is temporary. It's a mirror reflecting the insider ownership being monetized. Once the forward contracts mature in 2026 and the ownership transfer is complete, that short interest is scheduled to dissipate. Therefore, the short interest is not a sign of fundamental weakness, but rather a sign of a complex, finite transition.
I come at it from a different perspective regarding the short interest, particularly for the retail investor base that's betting heavily on that squeeze narrative, often using leaps call bets, long-term equity anticipation securities. While the high percentage sounds scary for shorts, the data severely undercuts the possibility of a dramatic, explosive squeeze. We have to look at the days to cover metric, which is the time it would take shorts to cover their positions based on average daily volume. Due to CFR's extremely high daily turnover, the stock moves massive volumes every day. The days to cover metric remains very low, fluctuating between 1.1 and 2.2 days. That low ratio dramatically dampens the explosive potential of any squeeze, allowing structural shorts to exit quickly and painlessly without a catastrophic price spike. The fear this structural selling creates is dilution fatigue for investors who worry they are simply being used as exit liquidity for the founding parties like Bitfury and V3.
Okay, let's shift the focus back to the specific price action, because this is where the conflict between future fundamentals and current structure became most visible. The stock dropped sharply from its $25.52 high in November down towards the $18 to $19 range. My view is that this was a classic technical sell the news event coupled with necessary institutional profit-taking after the stock had delivered a phenomenal 330% plus year-to-date rally. It was a reaction to the timing of the supply hitting the market after the AWS announcement, not a rejection of the fundamental AI infrastructure valuation thesis itself.
I am not convinced by that line of reasoning because the evidence points directly back to the supply dynamics. You cite the drop, but the sharp negative 10.41% move we saw on December 2, 2025 was explicitly and demonstrably linked to heavy insider selling reports that came through from V3 and Bitfury on that day. This was a clear liquidity response to a supply shock, proving that the structural dynamic remains the immediate price dictator. Furthermore, I argue that the price found its recent equilibrium around $19 to $20, not based on fundamental discounted cash flow models that analysts use to project AI earnings, but simply because that $19 to $20 range is the point where the new fundamental buying demand from the AI thesis finally managed to absorb and roughly balance the immense liquidation supply coming from legacy holders. The structural liquidation dictated the floor, not the fundamental valuation.
I see why you think that, and look, it's an undeniable truth that the friction is painful. However, the market's initial reaction to the AWS deal, the surge to $25.52, was validation that the conversion of their power sites from low-multiple Bitcoin mining to high-multiple AI data centers is the structurally correct path forward. The investment thesis is superior, and it is gaining institutional validation, evidenced by the large block trades taking place off-exchange. The volatility we're observing is simply the machinery of Wall Street working to digest a massive ownership transfer. Once the Bitfury stake is fully absorbed by the Jane Streets and Citadels of the world, the valuation gap must close, allowing CIFR to finally trade in line with its new high-multiple digital infrastructure peers.
I agree that the fundamental thesis is undeniably strong. The AWS deal is a monumental achievement. However, the stock remains structurally captive today. The systematic, large-scale unwinding of the Bitfury stake, which, as we discussed, is being managed through sophisticated, price-dampening instruments like the variable prepaid forward and heavy off-exchange shorting, means that volatility driven by these structured liquidity events will remain the norm. We are dealing with hundreds of millions of dollars in managed supply that must clear. Until that insider overhang clears completely, which we anticipate continuing throughout 2026, the structural friction will dominate the price narrative, irrespective of how good the fundamental news is.
The complexity here is genuinely fascinating. We have a powerful, game-changing fundamental story, the metamorphosis into an energy infrastructure company, clashing daily with the technical reality of a massive capital distribution. It means investors must weigh the certainty of the long-term, high-margin revenue visibility provided by the AWS deal against the near-term headwind created by the founding shareholders' highly optimized exit strategy.
Indeed. It is inherently difficult in a transforming stock like CIFR to cleanly separate these powerful short-term technical dynamics from the immense long-term fundamental value. The current pricing is not a reflection of future earnings potential, but rather a reflection of the supply-demand imbalance created by this ownership transition. It leaves the listener with a challenging calculus. When does the sheer weight of the fundamental strength finally overpower the structural suppression?
A question we will continue to explore as the VPF contracts mature and the HPC capacity comes fully online.
Absolutely.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel
to catch up with more stock insights and see you in the next video.